Hi, my name is Bob Brooks. Today I want to talk to you about how to invest in a declining stock market. Before we get started, as always, I want to make sure that you know the intention of these videos. These are educationally based videos. They're not intended to give advice. I'm not trying to tell you what to do. I'm certainly not trying to tell you how to think. That's the whole purpose of these videos is teach you the pros and cons so that you can draw your own conclusion. So always keep that in mind as we talk through these issues, these important issues dealing with money. I was back in 2007. I'll never forget this. I was talking about the risk that I saw building in the markets. I was talking about the subprime mortgage meltdown that I thought was coming. I was talking about the financial crisis that I thought was coming. I had no idea it would be as bad as it was. But I was just talking about this, and it's not that I can predict anything. It's just that I was looking at the facts and the figures and said, this is unsustainable. And so I'm talking about this. I talked a lot about it on the radio because I wanted people, I wanted listeners to be aware of what's going on. I wanted them to be informed so they could make good decisions for their own portfolios and for their investments. And so I got this phone call. I was on the radio. And this listener said, Bob, that's great. Thanks for the analysis. Thanks for the information. And I so appreciate it. And now, what do I do? You're telling us about all this stuff that could happen, and you're not telling us what to do, what the steps that we can take. Give us some idea. And that question has always struck me and stood out to me because as someone who manages money, I know what to do. I know what investments to use. I know what investments to stay away from. I know what strategies make sense in a declining market, and that's just through years of experience that I've learned that. But that's not something that someone can go really apply on their own with their 401k plan. And so I got to thinking, I don't really have a good answer for this. So over the years, I've developed what I call Plan B strategies. And this concept of Plan A and Plan B. Now, here's the thing, is that these strategies are ideas. They're ways to manage risk. Because the problem is, we're not taught how to manage risk, a good risk management system. We're taught how investments grow and growth. Everything's focused on growth. Now, this Plan A, Plan B concept is that Plan A is a good market and Plan B is a bad market. And so the mutual fund industry will have you kind of lead you to believe that these bad markets, it's not any big deal. You're a long-term investor. You just stay invested and you ride the roller coaster. I don't know about you, but if the market's losing 40, 50%, it doesn't make sense to me to be in it. So it's all about having this Plan B. Now, when I talk about these strategies, some that you'll like, some that you'll maybe don't agree with, some may seem kind of radical to you based on what you believe and what you've been taught, and then some you may want to combine 2 or 3 of them and have a big strategy. Now, let me tell you why Plan B is so important. I'll use the last bear market as an example. Now, if you go back in history, and I'm a big history buff when it comes to the market, if you go back through history, you'll see that there is an extreme number of years of bull market where the market went up, and there's a smaller number of years when the market went down, and that's called a bear market. Let me tell you why Plan B is important, because what the mutual fund industry will have you believe is that there's just a smaller number of years, so it's no big deal. And so if you look at between 2007 in 2009, where the stock market crashed and went through a devastating bear market, guess how many years that wiped out of growth? 18 months almost wiped out 13 years of growth. Do you think a Plan B is important? That's why I want to stress to you, don't just blow off these periods of decline. They'll tell you, don't look at your statements, just ignore it, just write it out. I don't think that you have to accept that. And the other thing, too, is I don't think that any investor should be on the stock market roller coaster where you go up, you go back down, you go back up, you go back down. And we go through environments like that. And so you want to be careful that you have a Plan B in place for a bad market. Now, in order to implement, there's a couple of things that are fundamental drivers to long-term success when it comes to investment success. So it's this, and these go hand in hand. It's the ability to control emotions and the ability to make decisions. One of a skill set that I would encourage you to read about, and there's books, tons of books written about decision making and becoming a good decision maker, because here's at the crux of it, is that every time you make a decision, when it comes to investing, and you're shifting from Plan A in the back of your mind, you're going to go, what if I'm wrong? And what that does is that puts that brick wall in front of you, creates hesitation. And then a lot of times people just look at changing to a plan B strategy, but they don't. They're taking losses and they're wondering, what if I make the wrong decision and the market comes back and it stops declining? So you have to become a good, effective decision maker, and you got to be able to remove that emotion. Anything financially, you've got to be able to remove emotion, because money can cause stress, anxiety, fear, you name it. I'm sure we've all experienced it to some degree. So if you make decisions through that filter of emotions, chances are you're going to make an emotional, irrational, bad decision. Make sure that you're taking a step back, realizing and acknowledging, hey, I got a lot of emotion here, but what I want to do, my goal is to make a decision not through the lens of emotion, but through the lens of practical information where you've weighed out the pros and the cons. So let's start out with the first Plan B option. Now, if you are a follower of pop culture finance, you're going to completely disagree with me. Most people who are in the business are going to disagree with me, and that is get partially or completely out of the stock market. This is the one thing they tell you never, ever to do. Don't ever get out of the market. Don't ever sell, because you're going to be wrong. And it's kind of one of those things, and then they publish all these statistics, but they don't publish the other side of the story. But they publish these statistics. We're going to do a teaching video on this, by the way, that tell you the biggest mistake you're going to make and show you why. But once again, they don't show you the other side of that if you get out of the market. So this is about looking at your portfolio and saying, you know what, I've made good money this year. I'm positive. I think I want to get out of the market, sell all my investments, go into a money market, and just kind of hang out there for a while. Now, or it may be partial, part of your investments that you want to do that. Here's the thing about it. Where most people make their mistake is they don't have a game plan to get back in. And that is the biggest mistake I see investors make. They don't have any idea how they're going to get back in, so they stay in cash. And guess what? They stay in cash for years because they never had a solid game plan and an agreement with themselves. This is how I'm going to do it. So it might be that you say, in 6 months, I'm going to take a look at this and evaluate. If the market's done this, the market's done that, I'm going to take this move. Whatever it is, or maybe it's going to, in 6 months, I'm going to start putting money back to work a little bit at a time over 12 months. Whatever the strategy, have one and be intentional about it. Don't get out of the market without any idea how you're going to get back in. That's the biggest mistake I think people make. Another Plan B option is adjust your risk level. And I talked a little bit about this on another teaching video, but I think it's good to bring this back up. And what you'll find on these teaching videos, by the way, is you'll find repeat teachings throughout some of these videos. Because the more times that you're exposed to it, I think the more that you really learn it and grasp it. So adjust your risk level. Think about putting your foot on the pedal, giving the car some gas, putting it on the brake, and pausing for a bit. This is the same concept with investing. So you're going to look at how much, the key question, what percentage of risk of the stock market do I want to take? Let's say that you're all out positive and you want to take 100% of the risk of the stock market. Well, then you'd have 100% of your money invested in stock funds. So that's how you base your risk. Well, let's say that you're not really sure, you're kind of positive, but you're kind of pessimistic on the market, and you're 50-50. So say you want to put 50% in stocks and 50%. And that other 50%, by the way, for most cases inside of 401ks goes into bonds. Now, I've done a teaching video on bonds and why you need to be careful in a post-financial crisis world. And bonds can lose value. So you got to be careful with the bond type investment that you use. And it may be that in a lot of 401k plans they have stable value funds. You could use that operate a little bit differently. But the bottom line is you want high quality, low duration type funds if the bond market is not in a good spot. So you got to evaluate that as well and not just buy into pop culture finance just because you diversified, you're in good shape. So determining what your risk level is, what level of risk that you want to take. So maybe it is that you want to take 20% of the stock market, then you put 20% in stock funds and 80%. Now, at any given time, you can adjust that mix. Now, of course, in any investment account or 401k account, you got to make sure you're very familiar with the company's rules on changing investments, because some will penalize you if you do it within a certain time period. So this is something else that you can do. Number 3, clean up your portfolio. Everybody at one time in their life had an investment mistake. It happens. It's happened to me. and put money into investment and go, wow, that didn't work out. And then there's that tendency to hang on to it as if it's going to come back, and it might come back, or it may just be a bad investment. Take the opportunity to go through your portfolio and say, this investment is no longer something I want to be invested in. This investment, maybe I want to take the profits in. Maybe this investment's a higher risk that I want to take now, and sell off that percentage of your portfolio and put that into cash. And then, once again, what's the rule of thumb? If you go to cash, have a game plan to get back into the market. But this way, you have the funds that you want to stick with versus the ones that you've just been hanging on to. And the other thing, too, is that this comes back to the whole decision-making skill set, is that sometimes we don't want to admit that we made a mistake in that investment. And so that keeps us, from a psychological standpoint, keeps us from making a decision. But if you're a plan B scenario, get rid of what's not working and get rid of what you don't like. Use lower beta funds. I talk about this in detail in one of my other teaching videos. And this is a risk measurement of a mutual fund. And it's not an absolute risk management. It is a way to manage risk. I like it because it's easy to understand, it's easy to communicate, and you can take this and you can apply it to a plan B strategy. Basically, what it means is that a beta of 1 is simply that you're taking the exact same risk of the stock market. Said another way, if you have your money in a mutual fund that has a beta of 1 and the market drops 40%, this is probably going to drop around 40% as well. If you have a beta of 0.5, that means you're taking half the risk of the stock market with your mutual fund, and that if the market goes down, you're not going to go down as much. If you have a beta of over 1, you're taking more risk in the stock markets. This is a great way to look at your mutual funds, or maybe build a different mutual fund portfolio of low beta stock funds. Now, having said that, you got to test out that beta. And they have betas for 1 year, 3-year period, 5-year, 10-year. But you want to look to see, how did that fund actually do back during the financial crisis? It's a great litmus test. In fact, you can go back to the financial crisis, you can go back to 2000 and 2002, the technology bubble that burst, and see if they did indeed lose way less than the market, and then see how quickly they made the money back. One of the things I found with low beta funds, I did a study on this, is that most low beta funds that were true to their beta lost, they did lose money in 2008, but they lost not nearly as much as the market, but they made that money back quicker. And that's the thing. Smaller losses you can make back a lot quicker than bigger losses. It takes a lot more time. So you can check the beta. Now I'm going to stop here and say this, is that now you can start to see how some of these mix together. So let's say that you want 50% of the risk of the stock market. Well, wouldn't it make sense to say, if I'm going to take 50% of the risk of the stock market, that 50% I want to be invested in low beta funds, and you can kind of start mixing that together and making these strategies work together. Another plan B option is to make room for alternative mutual funds. Now, I have some disclaimers to go along with this, and this is a newer category of mutual funds. Love this category because alternative funds, mutual funds, can actually help hedge some of the risk in a portfolio. Basically what the alternative mutual fund is designed to do is to go the opposite direction of the stock market. They implement strategies to make money in a declining market. Now, obviously, that's not guaranteed or anything, and there could be decisions that are made by that alternative mutual fund manager that lose money, but that's what they're designed to do. Now, my disclaimer is that there are a lot of alternative mutual funds that call themselves that, but yet they are far from it. And they're losing money while the market's losing money. That never made any sense to me. They shouldn't even be in that category. So you're wanting to make sure that you find some that are true to the category of being an alternative fund. So think about this for a second. Think about that you've got a portfolio, 50% in stocks, maybe 30% in bonds, and 20% in alternative mutual funds. Those stock funds go down in value. These go up in value, and you can see how this can start to offset this or a portion of this and limit your loss. So they do, I think, make a great alternative when it comes to diversification. Because what if you are in a situation, what if we face a situation where bonds and stocks both lose money? You got to have something making money in your portfolio. So picking the right alternative fund could be a great plan B strategy. Now, having said that, they're a little bit more expensive. I don't put as much weight on expense ratios as the mutual fund industry does, because I think if they're providing value and making money in a declining market is providing value, then that's okay. And there also there's a different set of risks that go along with it, so you want to make sure that it's suitable for you as well. But this can make a great Plan B option. How to invest in a declining stock market. If you listen to the mutual fund industry, it's all about Plan A investing and staying invested, whether or not the market's going up or down. We've talked about how devastating those market declines can be on returns, which is something they conveniently don't tell you. So it's important to have a Plan A when markets go up and a Plan B when markets go down, and to make sure that you know ahead of time, this is what I'm going to do, because a stock market decline can sneak up. Things can deteriorate pretty rapidly. You don't want to be just thinking about what my Plan B is going to be at the time when things are kind of are deteriorating in the market. You want to know ahead of time. But the best way to ensure potential financial success is to have a Plan A and a Plan B.